So we have recognized that behavioral finance deals with the psychology of people and how psychology of the people influence the financial decision of individuals. That is the main main area in which behavioral finance works, and we have recognized that that is the new paradigm, and it has been made revolutionary development in last 3 decades. And we also have learned that uh, several people have achieved the Nobel Prize for their contribution in finance in terms of behavioral economics. And can anyone recognize, or can anyone recall that to whom we recognize as father of economics? We recognize which person as father of economics?
Sir Adam Smith.
Adam Smith. So do you know in which year he wrote his famous book, An Enquiry into the Wealth of Nations?
Sir, 1776.
1776. Do you know what was his profession?
So he was a moral philosophy teacher at Glasgow University.
Okay, very good. He was a professor of moral philosophy in University of Glasgow at Scotland. Okay, so there was no economist at that time, and at this time when he wrote the book An Enquiry into the Wealth of Nations, which has been uh, contributing to the learning of economics still now, even after 250 years later. It has made a remarkable contribution, and it is still the basis of the modern economics. So before 1776, in 1759, he wrote another book, but for whatever the reason, the book didn't become much popular like the An Enquiry into the Wealth of Nations. So you may be curious which text he wrote before the Wealth of Nations, and which book didn't receive much popularity. So the text was the theory of moral sentiment. Have you got it? Theory of moral sentiment. Can anyone tell me what do you understand by the word sentiment? When I have written the sentiment, what you try to understand? Anyone?
Emotion.
Emotion? Anyone wants to add anything?
So pattern of behavior or behavioral pattern.
Pattern of behavior, behavioral pattern. Okay. Anyone? Okay. Feeling, sense, mood, emotion, all these are incorporated in the sentiment. And when we add the moral adjective with the sentiment, we know that what kind of feeling, what kind of sense, what kind of mood, or what kind of emotions we or he was interested with. So he recognized that there are so many greedy people in the society. So many greedy people in the society, and always people want to carve after praise. People feel happy when someone is praising him or someone is praising her for whatever the reason. So people carve for it, and people feel happy when someone praise him or her. And the way people behave seems to be the behavior of a greedy person. So that's why you see in every economics text and in almost every theory, it wants to convince us by saying maximize benefit, maximize utility, maximize happiness, and maximizing these things. And of whom? Of the stake of yourself. And no economic theory does not explain how Bill Gates is getting happiness by maximizing his contribution for the benefit of mass people in Africa. Can any economic theory explain it? That how Bill Gates is getting happiness by maximizing his contribution in poor Africa? What do you think? Have you seen any kind of economic theory or economic model that can explain this event, what I just have mentioned?
Sir, Maslow's hierarchy of need. The last stage is self-actualization.
Yeah. But is it an economic theory or a management theory? Does it come from economics? I'm not sure though.
No, sir.
Okay. So what I want to say that before writing the text Wealth of Nations, the theory of moral sentiment, which deals with the psychology of human, has been thought by or has been recognized very well by Adam Smith. So it helps us to recognize that how important it is that how psychology helps us or how psychology influences our decision-making process.
Sir, please be a little bit louder, sir.
Okay. So we need to recognize that how psychology influences our decision-making process and how influential it is. But when we think of economics or when we think of mathematics, most of the time we skip the part of psychology. So at the time of Adam Smith, there were not the people who are mathematician, they didn't have a very good number of friends. So it has been found that what's the reason? So the reason is that there were the mathematician didn't try to understand how psychology influences the decision making process. Mathematicians are always try to be rational. What do you think? Can you recall the example 2 plus 2 equal to 4? But we see that 2 plus 2 can be equal to or not equal to 4. We see this in real world. But can it happen in mathematics? Yes, no?
No.
It cannot happen in mathematics in any way. Mathematics should always be 2 plus 2 equal to 4. So that's why they do not want to recognize that how psychology can influence the decision making process and how the decision taken by the human, as human are influenced by psychology, how human brain can work differently than it is expected. So that's why mathematicians or the people who tried to practice mathematics, they didn't have a good number of friends. One reason is that they didn't want to recognize that people can make decision in a stupid way. And if you do it, 2 plus 2 not equal to 4, that person is stupid, obviously, in from the sense of mathematics. Is it true? Their decision will not be right decision. So one reason is that they didn't want to live with the irrational people, and another reason is that mathematicians often fail to make other people understand what they are doing. So that's why they didn't have a good number of friends. And what we want to recognize here, that human often make decision in irrational way. So the people have a tendency to exploit other people. Human history, if you want to summarize the history of human, we will try to, or we will recognize that human history is the history of exploitation or exploiting one group of people by another group of people. Do you recognize it? Human history is a kind of history where one group of people has been exploited by another group of people, and it has been happening for decades and decades.
Yes, sir.
Indeed, sir.
Okay. So if anyone does not make decision rationally, or if anyone is not rational, and another person, or one person is irrational and another person is rational, who is very likely to be exploited? This person or this person?
Irrational?
Yeah, irrational person is very likely to be exploited by the rational person. Okay, so by behavioral finance, what we want to see, that how people can be irrational, how people can make financial decision which seems to be irrational, and how as a rational finance manager, or how as a rational asset manager, or how as a rational portfolio manager we can exploit the irrationality of human or irrationality of mass people. Say for example, people are crowding after some tech stock, and they have taken the price of tech stock to a level which is above the fundamental level. So in the price which is now above the fundamental level, who are responsible for this price? These people? What do you think?
Yes, sir.
These people are responsible. Now who can take this benefit? Only the rational person can take the benefit. How the rational person can take the benefit? He will go for short selling. He will go for short selling. So in this way, a rational person can exploit or can get an opportunity to capitalize the situation which is created by the irrational people. So behavioral finance helps us to know that how people can be irrational and how to recognize the irrationality of the human. So in the behavioral finance, one of the very primary or very early contribution in behavioral finance is prospect theory. Is there anyone among us who have heard about this theory in any way, in any of his course, prospect theory? Anyone among us who has heard about the prospect theory term only? I'll not be asking what do you understand by prospect theory. If you say yes, you have heard about the prospect theory, I'll not ask from you. I'm just asking, by any chance you have heard about it?
Sir, I think I heard about it in my undergrad, but I totally forgot.
Okay, that is very good. And forgetting anything is the evidence that you are human being, right? Okay, so prospect theory has been developed by two famous people, not general people, Daniel Kahneman and Amos Tversky. Sorry. So these two people, so they have drawn the attention of mass people by writing the prospect theory and publishing this theory in the very famous journal in psychology, economics, econometrics. That journal name is Econometrica. Have you heard about this journal? And this is the paper. Let me open it for you. Prospect Theory and Analysis of Decision under Risk. In which year it was published? 1979. So how many years after the an inquiry into the wealth of nations? How many years? After how many years? An inquiry into the wealth of nations was the first book which recognizes that human beings are kind of rational decision makers. And after more than 200 years of Adam Smith text, okay. So this prospect theory was developed by Daniel Kahneman and Amos Tversky. So we'll try to learn about this. In which year? 1979. So if anyone has finished his behavioral finance text, it should be some key facts what we need to recognize, because this is the one theory which is the very foundational theory of behavioral finance, which recognizes the constraints of expected utility theory, which was proposed by, or which was initially developed by which person? Can you recall from the previous class? Expected utility theory. Who initially thought about it? Bernoulli. Can you recall this name? Yes, no? Then who popularized this expected utility theory? Newman and Morgenstern. We learned about it in previous session. So
Yes,
this
yes, sir.
prospect theory has tried to prove that people do not make decision in a way how expected utility theory has assumed. So before going to see that what prospect theory has contributed in the behavioral finance and what prospect theory has told us, we want to see some decision problems so that we can recognize that how people actually look like. So before going for those decision problem, recognize that prospect theory is a kind of positive theory. So there are some theories, or almost in expected utility theory, very beginning, expected utility theory is a kind of theory which is a kind of normative theory. So which theories are normative theory? Normative theories are those theories which tell that, or which claim that people should behave in this way, or people should act in this way, or people should make decision in this way. So can you recall we learned about some axioms of expected utility theory? Can anyone recall those axiom we shared in previous class? If you cannot connect with the previous class, that will be frustrating and that will be difficult to continue with the current session. We talked about some axioms in expected utility theory. Anyone?
Completeness and transitivity.
Yeah, completeness, transitivity, these are very two foundational axioms. And another axiom, we talked about independence. So what they are saying that people should make decision in this way. So expected utility theory is a kind of theory which is a kind of normative theory. But in positive theory, the positive theory are not saying that people should behave in this way. Rather, it recognizes that people behave in their own way. People behave in their own way and how people actually behave. So prospect theory is a kind of positive theory which says that people behave in this way. Let's recognize it. We should not say that people should behave in this way, because people people generally do not follow this. People generally behave in this in their own way. So that is the idea of prospect theory. We will talk about more later in today's session, but before that, let's try to check some cases. Say, for example, the first decision 1, and another decision 2. Say you will have a sure, or you are pretty sure that you will get $240, and another prospect where we can write other prospect with it, that 0.25 or 25% probability that you will have $1,000. You will receive $1,000, or you will have a gain of $1,000. And what about 75% chance here? What about the 75% here?
You will get 240.
That's 0.
75% chance of receiving nothing. Okay. So there is no way to lose anything. You do not have anything to lose. Okay. Now, which one you want to prefer between P1 and P2? The people
P1, sir.
who are preferring A1, can you recall the people who are preferring A1? They will prefer now P1 or P2?
P1.
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 Is my sound louder enough?
Yes, sir.
Okay. So which one you will prefer, P1?
P1, sir.
Okay.
P1.
What's the reason why you are preferring P1?
You are guaranteed to get 240.
Okay. You have a risk aversion tendency, right? Okay. If any person was a kind of risk seeking, would he prefer P2?
Probably yes, sir.
Yes, sir. Yes, sir.
Yes. Okay. So you have picked P1. I'm assuming that majority are with this P1. Okay. Now let me write other two options, P3, P4. So this is a kind of closing out your business, that if you close out your business right now, you will have a loss of $750, or you may take a chance that you will lose nothing in 25% case, but there are still 75% chance that you will receive 1000 if you continue. Which one you will prefer?
I prefer P3.
You prefer P3? Why?
Loss is minimized here. Sir.
How? Can you show
If
me
I,
the calculation?
No, sir. I think P4 is a good option.
P4 is a good option. Okay, what about other?
Because there is 25% chance of not having any loss.
Yeah, 25% chance of receiving, losing anything, right?
Yes, of not losing anything.
Yeah, you will have a 0. Okay. Anyone wants to?
expected return theory shows that the value is equal, sir. P3 and P4 is equal.
Equal. Okay. So which one? You have to pick anyone. You cannot go with both. You have to go with one.
Then I'll go, sir, P3, sir.
You will go with P3. Okay. What about other? Any other opinion? I want to listen from other people. This is the way how people make decisions.
Sir, P3.
Huh? P3. Okay. You don't want to take any chance, right? Because remember, expected outcome
Yes,
is.
sir. I want to risk.
Unfortunately, I can't listen you clearly.
Sir, P4 is better, I think.
P4 is better.
Yes, sir.
Okay. Can you quickly raise your hand to support P4? Okay, 5. Okay, fine. Put down your hands. I have got your opinion. Okay. Now, the people who are preferring or who are supporting P4, can you tell me which one is a riskier option between P3 and P4?
Sir, P3, sir.
P3 is a riskier option. Think twice.
P4 is riskier.
P4 is riskier. Anyone wants to intervene? I also want to confirm, or I also want to believe that P4 is riskier for us.
Sir, in P3 there is confirmed loss of 750, but in P4 there is still some, I think, 1/4 chance of not incurring any loss. So
Yeah.
isn't that better? I think.
I'm not
If
asking
we-
for better. There is no better. There is no worse. There is no wrong option. I'm just asking which one is riskier, which one is less riskier.
Okay, sir.
Sir, expected return theory says both are equal, sir. If you break it down, it
Yeah.
show the 750, negative 750 for P4 too.
Okay, that is the way how expected outcome is calculated. But that is not the way how risk aversion or risk seeking is calculated, right?
Right, sir.
Okay, I'm just
The
asking.
riskier option is P4, sir. Definitely P4 is the riskier option. There is uncertainty. In P3, there is no uncertainty.
Yeah. So the people who are preferring P4, are they risk averse now or they are risk seeking now?
They are
Risk
seeking
seeking.
risk.
Seeking.
They are risk seeking now. What does expected utility theory assumes? People are generally risk averse. This is the learning we have learned in every finance course.
True, sir.
It has not been taught by finance. It has been taught by expected utility theory. People are generally risk averse. That's why you have seen in previous class can you recall this one?
Yes, sir. Yes, sir.
Yes, sir.
Because people are risk averse, that's why people get more utility from the safer compared to the same expected outcome. Can you recall this? Can you recall this? Why we drew the concave shaped utility curve? Because people are risk averse or people are risk seeking? People are risk averse. Are you with me?
Yes, sir. Agreed, sir.
Okay. But what we are saying, people are not behaving in this way. People are sometimes behaving in this way. People are sometimes behaving in this way, right?
Yes, sir.
It depends in which context people are making decisions. Have you recognized it? Remember, this was a gain aspect, and recognize this is a kind of loss. People have changed their risk-taking tendency from risk aversion to risk seeking because they are in different context. They are in different context. They are not exhibiting risk aversion behavior. So first aspect is that people are not always risk averse. People are sometimes risk averse. People are sometimes risk seeking. Okay. Depending what kind of prospect has been presented before them. Can you recognize that these prospects are different from this kind of prospects? Have you got the takeaway in this discussion so far? Then we can continue.
Yes, sir.
Okay. Now take another aspect. Say you have become richer today by $300, and now you have a chance that either you will get 100 for sure, or you have a 50% chance of having 200. And you can immediately recognize what happens to the remaining 50%. And let's write for another decision problem where you are becoming richer not by 300 but by 500. Now you have two options. One is you will lose $100 for sure, and another is there is a 50% chance of losing 200. Can you tell me how can we summarize this decision? if we consider the final wealth, if it happens, what will be our final wealth?
Sir, in the case where we are losing 100 for sure, the final wealth will be $400 at the end.
Here.
But yes. So
Yeah.
in the second situation where it states that we have a 50% chance of losing $200, over there we will be losing, our final wealth will be $300.
Right.
So, sir, if I were given this choice, I would have chosen the first one.
You would have,
Chosen the first one where I would lose 100 for sure.
okay. Can you summarize it? If the first prospect happens, we will have 400, and here, if it happens, there is a still there is a 50% chance that I will have 500, and there is a 50% chance if I do not have the 200, that means I have a 0 after having this gamble. In that case, I will have how much?
300.
300. What you have said, you would pick decision 1, or you would pick this one, right?
Yes, the first one where I get 400
Okay,
anyway.
okay, fine. Let me summarize it in the same way. Okay. Here for sure, if I pick the first one, I will get 400. And what about if this happens? If it should be 50%, not minus 50%, 50% of losing 200. What about the remaining 50%? 0. What about the remaining 50% of having nothing? But I will have 500 initially.
Yes.
So can I write the 500 in that way?
Yes.
Okay, I have the 500 of 50% chance. And I will have 300 if this 50% happens, or if it becomes the real.
Yes.
Why you have picked the first one?
No, sir. Now I would choose decision 2. I thought the decision is between A and B of decision 1. So that in that case, I was choosing A.
Okay. So are this decision effectively same?
Yes, sir. Same.
These decision are effectively same. So if anyone chooses this one, he should choose this one. If anyone chooses 400, I mean this one in the decision 1, he should choose this one also.
Yes.
If anyone chooses the second one here, he should also choose the second one here.
Yes, sir.
But there has been several surveys made in estimating the people responses. It has been observed that people tend to prefer the first one in the decision 1, and the second one in decision 2. Are the people consistent?
No, sir.
So it has been found that people do not look at the final wealth. Based on the final wealth, we have concluded that these two decisions are effectively same. So it has been found that people do not look at their final wealth usually, which has been expected by expected utility theory. Rather, people want to evaluate an outcome based on the gain and loss, and they measure their gain and loss not looking at their final wealth, but comparing it with relative to a reference point. Reference point can be his current wealth. Based on his current wealth, will he have a gain or loss? Or he can look at other person's wealth, or he can look at current salary. And Daniel Kahneman and Alan Tversky has said that this reference point based on which people look at the gain and loss is an arbitrary. It cannot be identified, or it cannot be mentioned clearly based on which reference people are measuring their gain and loss. It has been found arbitrary, and it has been found a kind of random, or it is purely chosen by people, and there is no there should not be saying all people will look at their final wealth and based on that they will choose a decision, or they will pick the option in every decision. People most often do not look at their final wealth. Rather, people look at the gain and loss from a prospect based on the how gain and loss are related to a arbitrary reference point. And this reference point is sometimes and it has been found that this reference point is kind of not sure, or this reference point is not clear, or this reference point is a kind of pseudo reference point. And sometimes people want to say that my current wealth is my reference point, and sometimes people want to measure their gain and loss based on the person to who on whom he or she feels jealous. So he wants to compare that if I have this gain, how much richer I will be based on my based on this in comparison to this person, or in comparison to this person. So these things really happen. So these issues have been identified in the prospect theory. So let's try to uh, enter into more deeper in the prospect theory. And before going that, we also like to summarize another key takeaway, that is people feel more hurt compared to the happiness what people get from their gain. Say for example, I have a 100 taka gain, and I have a 100 taka loss. From a rational viewpoint, how much happier you should be here should be similar that how much unhappier you will be here. This should be same. What do you think?
Yes, sir. Yes, sir.
For the same amount of gain and same amount of loss, the increase of happiness should be equivalent to the decrease of happiness here. But many researchers have found that it is at least double. It is at least double. What do you think? Does it happen to you?
Yes, sir.
Yes, sir.
It has not been recognized by expected utility theory. It has assumed that people have a equivalent amount of changes in utility, happiness, satisfaction for increase, equivalent amount of increase and decrease of wealth. Okay, so let's try to recognize what have been. Is there anyone wants to say anything? So the third takeaway is people are averse to losses. People prefer the. Can you please mute your microphone if you don't want to participate? Okay, thank you. So people generally feel more strongly. People generally feel more strongly for the loss compared to, in comparison to equivalent amount of gain. Okay, so let's try to look at what prospect theory has given us. Have we got the problems people create in their decision making process, what we just have summarized in this discussion in last 20 or 25 minutes? Then we'll try to see that how prospect theory is trying to explain the behavior of the people. Okay, can you recognize the utility function we drew in previous class? And we have, for long years, we have recognized that people utility usually behave in this way, diminishing marginal utility. Can you recall this?
Yes, sir.
Okay. So people measure expected utility theory tells us that every prospect, people wants to take every prospect and people want to estimate the utility of every prospect and make decision based on the utility. So from previous class, you can recognize that we want to take the outcome to the utility function. Then we want to see that in which outcome our utility is greater. Then we conclude the, or people should take the option in which utility is greater. Okay. So instead of looking at the utility in this way, prospect theory has said that people generally do not look at the utility. People generally look at the value of the prospects. Do not forget the prospect concept. Each outcome with associated probability is prospect. So these prospects, when are presented to the people, people look at the value of the prospect. So this value is comparable to the utility or expected utility, but it is, the value is not equal to utility because value is different. So we'll try to see what does value means. So value is a kind of modified utility function. You can, I'm not inviting mathematical formulation here. Just recognize that value is a kind of modified utility function, which has been suggested by these authors, and recognize this paper has been recognized as a seminal paper. So which paper is seminal paper? The paper which has a greater number of citations. Are you familiar with the concept citations? Are you familiar with the concept citation?
Yes, sir.
Okay. So this paper has been cited more than 50,000. Can you recognize how much contributing this paper is? Let me show you the citation number in the social science. It is If I write the Kahneman, okay, no, this is not the paper. Prospect theory, decision making under uncertainty, and analysis of decision under risk. So this is an interesting paper. I would recommend you to read out this. You will not get each and every detail of this paper, but it is very interesting, which will also help you to review the concepts of probability you learned in your statistics and how people make decisions different from the way how it is expected. Under risk. Okay, you see, this is the original paper. You see how many citations here? More than 65,000. Can you see? Yes, no? Okay.
Yes, sir, we can see.
Okay. Kahneman has said that people value function can be drawn in this way. I do not, or I cannot draw very well. So if the line are not straight or the drawing is very poor, take it as straight, take it as adequate. Okay, fine. Here in the horizontal axis, we will measure the gain, financial loss. And in the vertical axis, we will measure the value. So what we can do, we can compare the value with the utility. So Kahneman has said that, can anyone tell me, is it the double positive quadrant?
Yes, sir, it is a double positive.
And it is the double negative quadrant.
Yes.
Or what do you expect? For having gain, value should be a positive number. For having gain, for getting gain, for achieving gain, value should be a positive number.
Yes, value should be a positive number.
Yes, sir.
And for having loss, value should be a
Negative number.
negative number. Okay. Kahneman has said that people value function can be drawn in this way. Does it look like a concave utility curve?
Yes, sir.
Okay. But the value function in this region where people have a loss, it cannot be written in this way. Don't forget the expected utility assumes in this way, all the way in the same direction. Okay. Kahneman and Tversky has said that the value function in the loss region should look like in this way. Is it interesting? Much different from the expected utility theory we have learned so far from the economics. Now we are learning different thing which is comparable but look like different for the gain and loss. So let me continue. Then you will get it very clearly. It is in a straight line. Okay. And you see there is a king. There is a king. And some authors also have recognized that based on the changes in wealth level, the utility function can be drawn in this way. Initially risk seeking, then risk averse, then risk seeking. You will get this in CFA text in behavioral finance, but I'm not drawing that here in prospect theory. Prospect theory is telling that value function should be, or people value function should look like in this way. Okay. Can anyone tell me this concave and this reverse concave, which one is more steeper, which one is flatter?
So the loss part one is more steeper.
Loss part is more steeper, and in the gain part, the value function is more steeper or
Flatter,
flatter?
flatter, flatter.
Flatter. So what do you think for the same level of gain, say for the same level of gain, say $100 gain and say $100 loss, in which case people will feel more strongly?
Loss.
Does it reflect your own feeling also?
Completely, sir.
Completely. Okay. So we see that there is a twist, and for gain there is a concave shape and there is a reverse concave shape, and people are acting differently for same amount of gain and same amount of loss. Now let me explain how Kahneman and Tversky has come up with this kind of different or unique value function for the loss part. And it has been used by many financial institutions for selling their product. People feel exaggeratedly bad about the small losses. Just try to think of that if you have 100 taka gain, that is okay. But if you have a 100 taka loss, you are feeling much worse. But just think of right now, we are in the age of 30s, or I have overestimated your age, or I should write 20s. Which one is good? Which one represent you?
20s.
20s.
Yes, sir.
You know the 20s, 30s. What does 30s mean? 30s is 20 to 29, and 20 means 10 to 19. Now, in which group you belong? This group or
Sir,
this group?
it will be 30s.
Yeah. First group?
Yes, sir, the first group.
Okay. Okay. Just think of, you just in this group 20 to 30, you have this remaining life according to the life expectancy in Bangladesh.
Yes, sir.
Okay, just think of this $100 loss. Is it very significant loss relative to the disposable income you will be earning during this age?
No, sir.
It is a very, very, very insignificant amount of loss.
Yes, sir.
What about other responses? Anyone wants to think differently, that I do not want to see that what will happen to my remaining life? I'm just wanting to see that my current loss is $100. I can't tolerate it simply. That's why I'm feeling much strongly. Okay. The thing is that, have you heard about the funeral insurance? Funeral insurance. Funeral. I should be appropriate in pronunciation. Have you heard about funeral insurance?
No, sir.
Anyone?
No, sir.
Yes, no. Okay. So funeral insurance is a very, very popular insurance in developed country. So you can easily expect what is the benefit from funeral insurance. What do you think between the funeral and life insurance? Which one is a big thing for you? Or which one is a big loss for you? If you fail to do this, or if you fail to do this?
Sir, I
Very
did
quick.
not get the question.
Sorry?
Sir, I did
Yeah.
not understand the question.
You have a question, or you didn't get the question?
Sir, I did not get the question.
Okay. Kahneman and Tversky say that people should be very, very concerned about the significant event of loss. People should not be very concerned about the small amount of loss, or small or very insignificant event of loss. Just look at these two events. One is funeral insurance and another one is life insurance. Which one is which one, or missing of which one will cause a significant loss to your family member? This one or this one?
So life insurance?
Life insurance. Anyone thinking that funeral insurance is a big event?
No, sir.
But there are million dollar business of funeral insurance.
Yes, sir.
People are convinced by the insurance company that they obviously require the funeral insurance to meet up the funeral expenses. But do you think it is a very necessary? It is a very small amount of loss with respect to the life insurance,
Yes.
or in comparison to life insurance. Okay. So, but people tend to buy insurance for a small amount of loss. Is it likely? Insurance is not a very popular in our country, but believe that insurance is indispensable in the life of people in developed countries. You see, for laptop, do we make insurance in our country?
No, sir.
For laptop?
No, sir.
For
No, sir.
bicycle? For bicycle? Do we make
No, sir.
insurance?
No, sir.
For cell phone,
No, sir.
No, sir.
for diamond ring,
No, sir.
these insurance are very, very popular in developed countries. People don't stop buying insurance for this small event, or where there is a very small loss, because people, why people are convinced to buy this small insurance or insurance for this small loss, because people feel very strongly for the small amount of loss. Okay, and people feel more sensitive to the losses. And can you recall the Richard Thaler I mentioned in previous class,
Yes,
the
sir.
Nobel Prize winner in 2017? Richard Thaler has found that people has a at least 2 times more, people get hurt at least 2 times more compared to the gain people get, or the happiness when people get for the equivalent amount of gain. So people feel hurt for at least for how many times higher? At least for 2 times more. Okay. So these are the reason why people buy this insurance for a small event, because people are more sensitive to loss. And from these people have a, they concluded, or they found that people have a loss aversion bias. People have a loss aversion bias. Because people have a loss aversion bias, that's why people go for buying insurance for a small event, right? And also because people have a loss aversion bias, that's why people do not like to go to a stock market. They overestimate the loss. That is another problem. But because people feel more strongly about loss, that's why people do not like to go there where the loss is likely. Remember, risk aversion and loss aversion are two different things. Risk aversion and loss aversion are two different things. Risk aversion is not a bias. Loss aversion is a bias. Okay. Do we have the asset managers with portfolio managers with us?
Sir, Achi sir, I'm here, sir.
Okay. Can you confirm that some of our investors, or not some of our investors, most of our investors continue to hold losing stocks
Yes, sir.
for
Agreed, sir.
long years?
Yes, sir.
This
Most
is
of
for
our
the,
investor, they do not want to take stop loss.
and at the same time, these people cannot wait to sell gain stocks.
True, sir. True.
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 It is the findings of this is the findings of loss aversion bias of people, that they want to hold the losing stocks for long time, unrealized loss for long time, because they feel that if they realize loss, that will hurt more, that will be very hurting for them. And at the same time, when people cannot wait to sell gain stock and wait long years for losing stocks, this effect is known as disposition effect. This effect is known as disposition effect. Have you got it? Have you got it, so that I can continue?
Yes, sir.
Sir, can you repeat again, sir?
Loss aversion bias is the findings from the prospect theory. Prospect theory has given or has discovered several biases. So one bias I just have mentioned is loss aversion bias, where people have a tendency to hold or for in loss aversion bias, people want to avoid those prospects where there is a chance of making loss. But at the same time, as people are avoiding those prospects for the chance of loss, at the same time, what they are doing, they are also missing the chance of gain. Is it true? If
Yes, sir.
people
True,
avoid
sir. True.
loss for this bias, at the same time, they are also avoiding the chance of gain.
True, sir.
Okay. So people are wanting to make happy by having 10% to 11% return from the savings certificate or সঞ্চয় পত্র in our country. People want to make themselves happy by getting 4 to 6% interest rate in depository banks or depository financial institutions in our country. They never have recognized that 13% annualized return is possible for stock market investment if I continue to make investment for longer term. From if you analyze 20 to 30 years data of our stock market return, you will see that annually you will see 13% return. But why people want to avoid this? Because people have a bias that if there is a loss, I will not be able to tolerate it. But at the same time, what they have missed, at the same time, they have missed the chance of gain continuously. So this loss aversion bias is a problem, and the investors will miss the chance of gain if they have the loss aversion bias. And don't forget that there is a 30% more standard deviation in our stock market return. So it should be known also. 30%, more than 30%, 32 or 33% standard deviation. Okay. So the thing is that if people have a tendency to hold the losing stock for longer term than expected, or than the desirable, or than the term which is claimed by fundamental analysis, and at the same time, if people sell their winning stock very quickly, it has been said that it is the disposition effect. Okay, I think I have repeated for clear understanding. Okay, let's continue. So have you got it, the value function given by the prospect theory, so that I can continue?
Got it, sir.
Thank you. So people prefer gamble. You know very well that people, some people love to play gamble, though it is not officially permissible in our country, but it is permissible in developed country. But why people does not, instead of having chance of enormous gain, people want to avoid the gamble, because people feel that they will feel more strongly for the loss they may incur after playing the gamble. Okay, so it's a kind of error in making decision that why they should feel more strongly in the loss region. They, But what happened? So the conclusion is that people feeling in the loss region and the strong gain region are not linear. They are non-linear response. Okay. And this is the replacement of what? This one? Can you recall? This is the replacement of what? Value function is replacement of what? I have mentioned several times. Recall it. I'm giving you time. Compare it with classical finance. I have mentioned that it is the replacement of utility function. Can you recall?
Yes, sir.
Okay. So in addition to the value function, prospect theory has given us another function, which is called weight function. So it can be comparable to the probability. So can you recall that we have used the probability when there is an uncertainty with the outcome? We have used the probability number with the outcome, then we have got the prospect. Can you recall that we have used the probability number? Now, in this discussion, we are giving the probability number. Do you think this probability number comes to you at a free of cost? The probability number, the probability estimation comes at free of cost. Do we have the portfolio manager?
Yes, sir.
Their probability number
Yes.
comes at free of cost to you?
No, sir. Never.
Okay. So the weight function is comparable to the probability number, what we use in expected utility concept. But the weight, how weight is different from probability? The weight is used by the people when usually people do not have the knowledge of probability, or people cannot estimate the probability in the way how probability is asking for. Rather, people estimate the probability in their own way. In that case, it is no longer a rational probability assessment. That's why the weight concept has kicked in. The thing is that when people do not have the sufficient knowledge of estimating probability, or people do not have the sufficient data to estimate the probability, they estimate the chance of occurring an event in their own way, and that chance is sometimes manipulated by people's belief. And that's why the percentage likelihood they give for an event is different from the probability what it should be for an event. For example, let me give you an let me write it down first, then I will give you an example. You see two lines, one is curved, another one is straight. This straight line is the probability line, what it should be, and this curved line, which has a kink here is a kind weight function line. For each curve, we have a function. From a function, we use we draw the curve. Okay. So the question is how weight comes. Weight comes from a function of probability number. This is a kind of manipulation by the people. People manipulate the probability number and people make decision using the weight. And now what is the characteristic of the weight people place on it, or people place on a particular chance, or people place on a particular event? Okay. Let me write down some probability numbers so that it will be more clearer to you. Okay. In vertical axis, we are measuring the weight function. This weight function is a function of probability. This weight function is a function of probability. Are you getting it? Why I'm writing it? Because I have said that when the probability is manipulated by people by their own subjective belief, that becomes weight. In that case, weight is a now function of probability. Weight is now function of probability. Yes or no? Are you getting the meaning of it?
Sir, not getting the theory, sir, actually. Why is
Okay.
the weight is a function of probability?
Okay. Say for example, an ideal probability number of something is, for example, 20%. For example, for having some return. Okay. Now say I have a positive sentiment. I'm very happy today. So what do you think? I will take this 20% granted, or I will try to believe that it will be 23%.
There is a possibility of bias that I might think it's 23%.
Yeah, this bias has been invited for what? Because I have some subjective preferences, I have some subjective belief. That's why I have diverted from the objective probability. Okay, so this is the weight and this is the probability. Now, how this weight 23% has come? 20% plus 3% error has come from my bias. Have you got it?
Got it, sir.
Okay. Now let me characterize the weighting function according to the prospect theory. Prospect theory has said that if there is a situation when the probability is either 0 or probability is 1, there is no difference between weight and probability. Can you give me an example of an event of which the probability is 1? Can you give me an example?
Sir, getting a return from Sanchaya Patra at 11% is 100%, and so the probability is 1.
Coincidentally, I was thinking same. I do not know how our thought has become same. Okay. So for example, 11.443%, for example, from a particular term savings certificate in our country, the probability of getting this 11.43%, I'm ignoring any default by the government that may happen, but that is extremely unlikely, which happened in Argentina, which happened in Greece. So let's assume that Bangladesh government will not behave how Greek or Argentine government or how Zimbabwe government behaved. So let's assume that it is pretty certain. In that case, what do you think? Should it be different? Should there be any place for any bias which will make the weighting different from probability?
No, sir.
No. Okay. And can you tell me about an event of which probability is 0? That government, Bangladesh government will make default. We are in the same example. Bangladesh government will make default in the savings certificate. The probability is
0.
0. In that case, there should not be any difference between weight and probability. Got it? Okay. So Kahneman and Tversky have recognized this, that when the probability is either 0 or 1, there is no problem. But when the probability number is between 0 to 1, people make problem. Have you got it? When people make problem? People make problem when the probability is in between 0 to 1. So I'll tell about what kind of problem people do make. Before that, I like to clarify another thing here so that you will not make mistake like me. When I will tell you the probability number cannot be 0, cannot be 1. But I have mentioned probability of 0, probability 1. It should not be the probability term. These are the certain, and it will not happen. It is certain. When we should say probability, probability should receive number between 0 to 1. Okay, so let's continue. People have a tendency that to estimate probability to some event when the true probability, to overestimate the probability when the true probability is very low. People have a tendency. Here I should write the probability in the horizontal axis, and in the vertical axis I'm writing the weight. So it should be 0.1, 0.2 in this way up to 1. Can you tell me what is the probability that Biman Bangladesh Airlines will crash tonight?
This is very low, or
It
lower
should
than
be
0.1%.
here, or it should be here, or it should be here. In which region it should be?
Before 0.1%.
It should be here.
Yes, sir.
But do you think people estimate that Biman Bangladesh Airlines will crash here, or people have a tendency that people believe that it will crash? The chance is 10%. What do you think? People believe in here, or people believe here? The passengers?
There is some bias because the brand value and so on. You might be right
Okay,
that
that may come. Forget about Biman Bangladesh. Just think of airlines. Just think of airlines. Just think of airlines. Now tell me, there is no bias. There is no place for bias for any brand name. Just think of, what do you think?
Yes, sir.
In which travel people feel more cautious? In airlines travel or road travel or
By
Airlines.
air.
air? So what do you think? People, the chance, the cautious for what? Cautious that the pilot will not, a pilot will not have a good landing, or pilot will not make a good fly, and there is a chance that plane will crash. But the probability is very low. Which probability? True probability. But what people believe? People believe that the probability is higher. That is how people place weight, and that is how this weight is different from the probability. Have you got it? Have you got it?
Yes, sir.
That is the reason before entering into the airport, airlines sell charter insurance, and people stand in a queue to buy this charter insurance. Insurance company recognizes this bias of the people and sell the insurance in this way, and people do not stop buying this. Have you got it? Am I clear to you how this weight function differs from the probability and how the weight function is characterizing people's behavior?
Yes, sir.
Okay, now say right now COVID is going up. For several weeks, COVID is going up. So compared to last few weeks, the chance of getting infected with COVID has gone up here. The true probability, for example, what do you think? Earlier, for example, the chance was here, but now the chance has become increased to here. But do you think people are believing that the chance of getting infected here, or the people are believing that the chance of getting infected is here? Which one is true?
Probability is higher. They are thinking of the higher value.
So it has been found that when the probability of an event is high, true probability of an event is high, people have a tendency to underestimate the probability. And when the probability of an event is truly low, but people have a tendency to overestimate their probability. Have you got it? Okay, so let's conclude by giving a concluding example. People do not stop buying lottery. From your childhood, you listen to the miking that people they're announcing for buying lottery, right? Do you think the lottery selling has stopped nowadays? What do you think? Any idea? Lottery selling has not stopped because people have become smarter. People go to bank, and bank uh, teller shares the information that there is a lottery, you can buy lottery. And people buy lottery from the teller's desk. And people also buy lottery by sending SMS. I think many of you have purchased SMS or sent SMS for different lottery type events but have a very unlikely that you have received a gain or you have won the lottery. What do you think? Am I correct?
True, sir. Various types of quiz and so on.
Right. That is also part of, that is also kind of lottery. Am I right that we do this kind of practice?
True, sir.
We do.
We do, sir.
Okay. So what do we think? We think that probability of winning is very high, right? But what is true? The probability is actually low, but we place more weight. Okay? That's why we do not stop sending SMS. Okay? So that is how Daniel Kahneman and Amos Tversky have attempted to explain and to codify the behavior of the people. What can you do? You can go through the text, chapter 3 of your text, and try to understand what we have learned in today's class. And I would strongly recommend you to try to go through this paper. I will not test you based on this paper. I have not gone through this paper well, or I'm not very adept in understanding each and every topic of the paper, but it will be very encouraging and inspiring to you if you're really interested in behavioral finance. So let me stop the recording here.